Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And one of the reasons I'm making these videos is because I get unsolicited requests like, "Hey, should I do this?" Right? Like, so one of the questions I get is like, "Oh, I have a 3% mortgage. Should I replace it with a 9% line of credit?" Now, if you know um, what I've been saying in this channel, or if you've seen previous videos, you'll know that I always say like you got to do the math, right? And every time I've done the math in this channel, not replacing your mortgage with your line of credit has always been superior to replacing your mortgage with the line of credit. And just in simple terms, we'll explain why, right? So ignore the interest rate for now, but let's look at the amount of debt that we have compared to the payment, right? So let's say I pay this $27,000 credit card off. How much payment do I get back for replacing the $27,000 for getting rid of it? I get $855 back. But if I pay off this $200,000 loan, and I know people get really excited to pay off their mortgage, right? Because it's tied to your home. I only get $843 back. So which one should I focus on, this credit card or this mortgage? I would definitely focus on this credit card because the payment amount that I have to pay for that $27,000 is much higher than this $200,000, right? So we have to be aware of that the amount of bang we get for our buck is very low for replacing the mortgage, and this is why mortgage replacement um, is, in my experience, has never really worked out, especially if you have a low percent mortgage, like a low interest rate mortgage versus a higher interest rate line of credit. This is the only time that I emphasize that, hey, the interest rate does matter if you're going to place a low interest rate mortgage or where there's like a difference between that and the line of credit, right? And instead of like just throwing out terms like amortized or simple interest, do the math. That's really important, right? So do the math. So let's go ahead and just do a comparison between mortgage replacement and not replacing the mortgage. So first of all, what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account, and we assume two things with it. It's we have the same income and we have zero savings, but even though we're having all of our money into the line of credit, there's a step before that, or there's a plan before that we have to make before that. And one of the most important things is planning the debt payoff order, right? So we're going to go into that just in a brief moment, but I do want to throw that in there. That's not simply just throwing your money into a line of credit or replacing your mortgage. Okay. So let's go ahead and I'm going to go over this really quickly. So I might be skipping a few things compared to other videos, but in order to do velocity banking, we have to have two things. Oh, I probably erased it. Number one is a budget, and then number two is a line of credit as our main operating account. So let's say for whatever reason, we were able to get a huge home equity line of credit as our first position mortgage, right? Or replace our $200,000 3% mortgage with a 9%, which is pretty good interest rate nowadays, with a 9% $300,000 home equity line of credit. So when we replace the line of credit, this 200 oh, is it 200,000? Okay, so let me put $200,000 here is going to be the balance. And actually that's just for the home equity line of credit or the mortgage, right? But we also are going to do a full replacement of everything. So it's $200,000 plus the credit cards, plus the two credit cards and the auto loan. And so that's where we're getting $267,000, I believe. But let me just do a quick check. So 15 plus 27 plus 22 plus 200, and then that would be 264. So let me just put 264 right here. So let's assume that not only we are going to replace this 3% mortgage, but we're going to replace this 27, 26% credit card along with the 6.5% auto loan, right? We got to do that, okay? I think it would make most sense to include these as well when we're if we're going to get a first lien HELOC to replace our mortgage. But so let's do the mortgage replacement scenario. And again, what if we transfer the debt? Guess what? These go to zero. And so now we went $1,383 of savings to $4,000 of cash flow, but we have not included the interest cost to use that line of credit as our main tool, right? And so the actual velocity banking strategy is you put your entire $6,000 into the line of credit, expenses out, and after every single month, it should go down about $4,000. And let's just quickly do the math here. And to get the next month's balance, it's the previous month's balance plus the previous month's interest minus our cash flow, which is $4,000, right? And then, okay, what we're going to do is we're going to take the average daily balance. Let's go ahead and get the average function, multiply it by the interest rate, which is 0.09, right? And then you divide by 12 because 12 is uh, I'm just mixing my words, but 12, we divide by 12 because it's calculated monthly, so the interest rate is quoted annually, but we have to divide by 12 because the statement balance, I'm sorry, the interest for each period is calculated monthly, okay? And then you could see here, we have to pay $2,000 of interest for replacing our mortgage, and so let's go ahead and copy and paste this until this all goes to red or zero or whatever. And then, we got a couple months. So as you can see, it's decreasing, right? It's slowly decreasing with this strategy. And now we can see right here in about 91 months. So let me just do a quick calculation. In 7.58 years, we pay off this mortgage. Okay, 7.58 years. So let's go ahead and remember that. And then also what we're going to do is we got to sum up all of the interest that we're paying, right? So let's sum it up. And that's about 100 grand of interest. Okay, so let's go ahead and mark this down. So let me see if I can just do this. All right, so now let me put it here. And so it will take 7.58 years and 100K of interest to pay off your entire first lien HELOC if you decide, hey, I'm going to replace everything, and just do the velocity banking strategy for the first lien HELOC. Now, 7.58 years, that's not that bad, and that includes the mortgage, right? So I don't think that's that bad, but for some reason, the $100,000 interest is, I feel like we can do better. And let's try the no replacement scenario, meaning that we're just going to take a few debts at a time. So definitely the credit cards first, and then the auto loan, and then the mortgage, and see how we get what our result is there, right? And so let's go ahead and restart again. So we're not going to start from 264, okay? And we don't need a huge line of credit. How much do we need? We'll start out with 50,000, okay? So 50,000, right? And then what is this summed up? So it's 15 plus 27. So that'll be 42K. Or I'm sorry, yeah, 42K. So let's do 42,000 as our starting balance, right? And our cash flow is definitely not going to be 4,000. So let's include that here, but it will start at a 2,700. So let's go ahead and 42,000 right here. And so that's going to be 2726.34, right? So that's our new cash flow. And then we just copy and paste, right? And then we'll just see how long it takes us to pay off those two credit cards. And we can see it takes us pretty much about 17 months, okay? So 17 months, I don't know if you'd argue, yeah, 16, 17, no, that's all good. All right, so we'll just say 17, be a little bit conservative, so 17 months. And then we got to calculate the interest, right? So let's go ahead, and I think we can just take out these negative numbers, so let me do that. And I'm going to sum it all up. And so that's going to be about $2,000 of $2,600 of interest. Okay, so we're going to make sure that we have all the interest calculated, and then let's do this, copy and paste. So it's to pay off the credit cards. It took us 17 months and $2,600 of interest. Okay, so now let's go ahead and pay off our car loan, right? So car loan right here, 22,000. And let's see at month 17, we have this fancy calculator I made in Excel, 1717, right? How much interest have we paid? About $1,790 on that car loan. And because our cash flow index is below 50, if you don't know what that means, go look Google cash flow index. Uh, I feel comfortable moving this loan into that line of credit. So let's go ahead and do that. And we'll put this number right here. And let's do this. Okay, so one more time. All right, so now let me go ahead and highlight this because this is where we're going to move our car loan, right? So let's go ahead and add it right here, plus 16472 2.45, right? And then, right, so once we've done that, blam, this goes to zero and our new cash flow is 3156.79. So let's go ahead and write down, whoopsie, did I screw up? So let me copy and paste this. And all right, so now what we do is we write down our new cash flow of 3156.79. And let's go ahead and do this here. And I'm going to go ahead and copy this. And then you'll see, okay, you'll see that it took us about 22 months to pay this off, right? 22 months, okay? And so now what we got to do is we pretty much have to sum up this interest from here to here, to calculate the cost of using that line of credit, I think. Let me highlight this here. So give me one moment. Okay, so let's do this. I'm going to copy and paste this. Oh, division by 0. Okay. And then I'm going to sum these up. So sum them up. So $263.25 approximately, along with the $1,000 of car interest that we got to pay. So let me sum these up. So about 2053. So let me just do this. So the car loan took 22 months total. So that would be 5 months. And then it'd be 2053, 53 interest, right? So that's 22 months, okay? And then now what we do is we just calculate, we attack the mortgage last, and the reason why we attack the mortgage last is because, listen, for this $200,000, we get this itty bitty $843 of cash flow. That's a no bueno. That's why the mortgage is so deceptive. And the other thing that's really deceptive too is just how much interest you pay. So let's say we take this out to the full term, 360, right? We pay $100,000 of interest for that $200,000 of loan, even though it's 3%. And then if it's like 6%, oh man, we're paying for like more than 2 houses. You know what I mean? $200,000 loan, $230,000 of interest. And if it's 9%, it's like we're paying, well, actually technically 9.4. It's $400,000 of interest. Isn't that crazy? So got to be careful of those hard money loans and those investor loans and realize why we have to pay them off. So let me go ahead and do this. And then let me go ahead and figure out. So 22 months, right? We got to figure out what the balance is. And why is it red? Oh, this is, wait, I screwed up. 22 should be here. All right, so now we have paid $10,000 of interest at 22 months. So let's remember that. And then we're just going to use our velocity banking calculator to kind of finish off the rest just because I don't want to be here all day. And so let me go ahead and open that thing up. Give me one moment. All right, so I pulled out this velocity banking calculator provided by Renatus, which is where I originally learned velocity banking from in 2017. So if you're interested in enrolling in online educational classes, and they have communities all over the United States, go ahead and click the Google form link below, but it will cost you money. And for some reason, people don't like to pay money. But let me just tell you this, right? If you don't pay, you don't pay attention. Okay? So that's why I don't mind charging people money. You don't pay, you don't pay attention. Anyways, so let's go ahead and do this. And so I'm just going to compare two scenarios, right? So let's say we decide to fully replace this mortgage with our line of credit, right? 9%. Take a look at this. 5 years paid off and $47,000 of interest. But if we do this in small chunks, right, where we're not replacing our line of credit with a mortgage, let's say $6,000 chunks, 4.3 years and 13 grand of interest. So you can, yes, replace your mortgage, but why leave money on the table and time on the table as well? I don't want to do that. Do you want to do that? I don't want to do that. So the amazing thing about this chunking strategy, it's very resistant to interest rates. So even if I had a 30% credit card, 30%, let's see how much more I would pay with a 30% credit card. Well, blam, 5 grand more. So if you have points and rewards and all that good stuff, you could probably just offset the interest. Or you could also think of it like this. Hey, I'm okay with using this 30% credit card and just paying a couple grand more interest because, if I want to expand my credit base, I am going to have to pay a little bit, but I don't want to pay like 50 grand of interest. I'm okay paying maybe five more than I normally would. And look at this, it pays off in 4.5 years. So that's one way you can think of it. Now, I don't know if you know this or not, but there was a person who paid a Tesla with a credit card and got all these rewards travels points. So that's something to consider. Again, so even if you want to use a 30% credit card, why not, right? If the bonuses justify the interest rate, and we have to look at the overall holistic picture. But let me go back to 9%. So let's go here, 4.3 years, and we'll just say 14 grand or 13.9 grand. It doesn't matter. So let me go ahead and to the other calculation sheet right here, and we gotta record the 10 grand, and we also got to record the 13.9 grand. I'm just getting confused. I got too many windows. So 4.3 years. So 13.9, right? And so let me go ahead and let me just do sum of J3 to J4, right? So 26 grand or 24 grand, right? So let's go ahead and write this right here. So 24 grand. And then credit card, car loan, 24 grand. And how long did it take us to pay it off? Whoopsie. Give me 1 second. My alarm went off. Okay, so let's get back to business. So let me just go back here. So this is 22 months, right? So 17. So we'll just do mortgage right here. And then let me go back to that calculator. So it will be 4.3 years, 4.3 years, and then we'll just say 24.6K interest. All right. So now let's go ahead and add it all up, right? So equals 17 plus 5 plus, or let's do divide by 12. 17 divide by 12 plus 5 divided by 12 plus 4.3, and then that should, not 3.4, silly, 4.3. Okay, so 6.13 years, right? So 6.13 years, and then let's calculate the interest. So it's 2,600 plus 2,053 plus 24,600. So about almost 30K, so 29.2K. Okay, so 29.2K of interest. So you tell me what's more attractive to you, replacing your mortgage and how, let's actually calculate the difference, right? So 7.5858 years and then 100K of interest. And so what's the difference? So equals 7.58 minus 6.13 and then 100 minus 29.2. Okay, and this is a dollar sign. I gotta just reset this and then let me format this to general numbers. Okay, so 1.45 years, and actually let me rewrite this. 1.45 years, and then 70.8K of interest. So if you do the mortgage replacement method, you do spend 1.45 years more time in order to pay off the first lien HELOC. But here's the part that I really, 1.5 year. So let me tell you my personal criteria or philosophy of let's say it did take me more time. If it, let's say it took me one more year, but somehow I was able to pay less interest in this, I'd do it. Like, okay, what's another year? But I'm paying in time 1.45 years. Like I'm actually paying in time and in interest 70K more. So which one would you do? Would you replace your mortgage, your entire mortgage, and all of your debt with the first lien HELOC, or just do it one at a time, right? One at a time. One at a time is clearly, and this is why I like velocity banking. The most nuanced parts are the ones that you just can't, you have to do the exercise yourself, right? That like certain things like the debt payoff order and chunking are not obvious to unless you've taken the classes, which is why like I know a lot about this stuff because I learned this from Renatus. Insert ad Renatus ad here as kind of the takeaway of what you need to do after this call, and click the Google form link below. But my point is that we just can't listen to the internet and say, oh, everything, I just do something really simple and then everything will be okay. No, no, there's a little bit of nuance that we have to take into account. And that's why I always do comparisons and I always look at the trade-offs, right? Because sometimes you might actually pay more. So for example, when I talk about expanding your credit base, if you never take out a loan or a line of credit ever in your life, you'll probably save a lot of interest, right? But you probably missed a lot of opportunities as well. So if I pay maybe 10, 20, 30 grand of interest instead of 100 grand, yes, I'm willing to pay that interest in order for easy access to opportunities, but I'm not going to pay 100 grand of interest, right? Got to be aware of that. All right. Well, that's it for today. So with the $70,000 of interest that I saved, probably buy a few Teslas, even though I've technically never bought a car before. Weird how I've bought in a house, but I've never bought in a car. So, because I've gotten hand-me-downs and my 2003 Toyota Camry still works. All right, well, that's it for today. Have a great day. Just want to crank out a video for today, get that YouTube algorithm going, and we'll speak next time.